So, despite all the worries about tariffs, S&P 500 companies are still expected to grow their earnings this quarter by about 7% year over year. That's not nothing. And by the way, that would be the 7th consecutive quarterly increase.
That's true, but here's the thing. At the start of the year, that expectation was almost 12% growth, so it's come down a lot. And a bunch of companies are already warning that they might not do as well as they previously thought.
All right. It's complicated. Well, thankfully, our guest this week will take us through what exactly is expected for corporate earnings season. Hey everyone, I'm Telis Demos. I write for the Wall Street Journal's Heard on the Street. And this is WSJ's Take on the Week, the weekly podcast where we give you a leg up on the worlds of money and investing. Each week, we bring you conversations with insiders and from inside the Wall Street Journal's newsroom about, well, mostly about tariffs, frankly. Frankly, we mostly talk about tariffs. I will briefly reintroduce someone that everybody should be familiar with now, who is Miriam Gottfried, who is on her last guest hosting assignment before Gunjan Banerjee returns, but first in our hearts still. Miriam, welcome again.
It's great to be here, Telis, and I am very excited to talk to you about tariffs again.
Yes, well, this past week, there was obviously big news in the world of tariffs, the market's obsession. And it was, quite honestly, it was pretty dramatic. I was having trouble sleeping last night, just sort of thinking about how to pull it all together on today's podcast. We're recording this on April 3rd. The market has obviously reacted quite strongly, but I think the drama is even beyond, and we'll talk about what's going on with stocks and earnings and things. But I think this is just like a kind of it just feels like one of those you read about in your history textbook kind of moments, right? And regardless of what comes next, it just certainly seems like this announcement has kind of knocked everybody off their axis a little bit. Miriam, can you take us through exactly what transpired last night? Because I think, just setting it up, I think that this was beyond what people were saying, I guess, depending on your point of view. Best case or worst case scenario for tariffs would be what was ultimately announced was maybe even in excess of those scenarios.
Yeah, the administration did not hold back. I think there had been a view beforehand that they will either take the across-the-board tariff approach, one flat rate for every country to pay on imports, or there will be this reciprocal approach where we're trying to bring other countries into parity with what the U.S. Has to pay. And in fact, there was both. So we have, first, a 10% across-the-board tariff on all imports, and then even higher rates on top of that for countries the White House considers to be bad actors on tariffs. And there will also be a 25% duty on all foreign-made cars, which was sort of, forecast. And we kind of knew that was coming. Let's go to a clip from the announcement.
We will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that.
So these are pretty extreme changes, and the market reacted pretty dramatically right afterwards to this news. There are a lot of different products whose prices will likely be affected by these tariffs.
Yeah, and it seems like you said, both things happen, right? Even countries that have trade, that the U.S. has trade surpluses with, will be paying I think it's a 10%.
10%, yeah.
is the proposal as it stands now as we record. And then countries that had a trade deficit, it seems like, the Journal had a story laying out, basically the math they did, which was how big is the trade imbalance with the U.S., right? How much more do they buy from us and we buy from them? And then taking that amount and I think in some cases basically dividing it by 2 and saying that's going to be the tariff. And so those add up to big numbers.
And that's why Trump positioned these numbers as being kind to other countries. We were being nice to them because we're not doing the full trade deficit. We're taking it and cutting it in half, and then that's what we're charging them. But these are big numbers. These are big numbers, and they're, I can't tell you the number of products in my house that say made in Vietnam, made in China. This is where a lot of our goods come from today.
Yeah, and we can and will have long discussions about the economics, of these things. There are obviously people on both sides of the issue who feel very strongly that this is the right or wrong way to go about things. But in the meantime, let's talk about what the markets have been doing in reaction to that. And, one thing that the markets have really been struggling with is not even so much what the tariffs are, but just the exact policies, but just that it is done and dusted and in the books. I perhaps the market now will at least have some certainty that, okay, maybe these tariffs will be slightly different, but that they will be dramatic and significant either way. Because there are still some exceptions, right? I think that Canada and Mexico, for now, are not involved in this reciprocal regime. Whether or not those things stick around, we'll see. But it does seem like there's at least certainty that they weren't joking when they said that they wanted to do something very significant with tariffs, right?
That's right. I think that's true. And I think what people will look for now is whether some of these individual countries decide to strike deals with the U.S. to try to negotiate these rates down a little bit. I mean, that's what the goal of reciprocal tariffs, right, is just try to kind of bring people to the bargaining table and get something out of them. So I wouldn't be surprised if pretty soon we start to see certain countries coming forward with proposals that, might appease the White House and get some of these tariffs to be modified.
Yeah, and so again, for the time being, here we are, speaking the morning after the announcement, and the U.S. market is down, by it's down at this very moment by about 4%. We'll see, how that plays out over time. But I think that next week people will be looking for those announcements. There's also the Consumer Price Index update next week. We'll see if there's anything in that report that kind of gives us a little view of, obviously, one of the main concerns about tariffs is that it will raise prices here in the U.S., that we will all be essentially paying for these tariffs if they are passed along to us in the form of higher costs. And so we'll see in the CPI, which obviously will not include what's happening now.
Right.
It's backwards looking. However, we'll see if companies have started to raise prices on things ahead of tariffs, maybe as they have tried to buy things up that they want to hoard essentially before the price of them goes up, right? If you're buying raw materials and things like that, we'll see if those things start to filter through to prices. The most recent inflation reading we had, the Personal Consumption Expenditures Index, that was pretty hot. So I think people might be a little interested in what goes on with this consumer price index.
Okay, let's move on to the earnings front. The first quarter earnings report season is popping off this coming week.
Miriam, which ones are you going to be watching closely?
I'm really curious about Delta, which already lowered its guidance along with many other airlines. The amount that businesses and consumers spend on air travel, I think, is an indication of their sentiment, their optimism about the future, how much they believe they can, shell out versus how much they have to save just in case things go wrong.
Absolutely. Big consumer read there. And then I think one I'm watching is CarMax. They are the kind of car seller. They sell out of used cars. It's going to be super interesting, I think, to see what happens with them. Their stock has been a bit of a roller coaster lately because on the one hand, if you tariff the importation of new cars or new car parts, that should, I think a lot of people think, make used cars prices
more
go
popular,
up.
Yeah.
So in theory, that might be good for CarMax, but in the immediate aftermath of the tariff announcement, their stock was down. So I think it'll be really interesting to see what they say.
That was just everybody selling off autos. Who knows?
Sell your winners. Maybe that's the old saying goes. So it'll be interesting to see what they report and what they say, and also how the market reacts to it. But I want to step back a little bit on earnings, given the environment that we're talking about here. Obviously, we know that there are worries about the economy amidst what's going on with tariffs and frankly, other kind of big policy changes. There are recession risks that people are talking about. But that is not the same as saying, how are companies themselves actually doing? Corporate earnings. Because as much as big companies collectively make up, our economy, they employ us, we buy stuff from them, their fates and the economy's fate are not exactly the same. Tariffs could increase costs. Maybe companies pass along those costs to consumers. Maybe some companies raise their prices because other prices are going up and they end up making more money.
That could at least improve profitability in the short term. We don't know.
Absolutely. What if companies lay people off and improve their profitability that way, right? We could see a struggling economy, but companies doing okay to maybe well. Or
at
maybe
least
not.
in the short term. Because I think, consumer spending is still an important part of the economy. And as that comes down, that will eventually affect
companies need to sell stuff to someone.
Yeah.
Those someones being
consumers.
You, me, people.
Exactly.
And then does the market even care? Right? Does the market care about how companies are expected, their earnings are expected to perform? Because really, the market is sort of two things, right? One, it's a sort of prediction of what company earnings will be, and then also how much it values those company earnings and what kind of volatility it expects from those things. So, and there are times when companies have great quarters, they report big positive earnings, and then their stock goes down. And that makes our jobs as reporters interesting, but also difficult.
Because we have to explain it.
Because we have to explain why that happens. That brings us to our interview this week. We spoke to Christine Short. She is the head of research at Wall Street Horizon, a TMX Group company. And she looks at earnings in really a mind-boggling level of detail. So she talked to us about what we should expect from earnings season, what impact tariffs could have. We looked at a bunch of different sectors, individual companies. It is a wide-ranging conversation and a user guide to the upcoming corporate earnings season. Stick around for that. It's going to come right after the break.
Today in the studio, we are joined by Christine Short to talk about first quarter earnings, which kick off this coming week. She is the head of research at Wall Street Horizon, a TMX Group company. Christine, welcome.
Thank you so much for having me.
So we are about to enter earnings season, and tariffs are looming large. What does that mean for corporate earnings? Will some companies be able to pass these tariffs along, and what kinds of companies will struggle to do that?
Yeah, well, we heard about tariffs a lot in the last quarter. In the Q4 reports, once it was confirmed that President Trump was in office, we started to hear a lot more about companies how they would be impacted by tariffs, what they would do to either pass those on or move their production facilities. And actually, I will say in Q4, we saw the most tariff mentions, even going back to the first Trump administration. So over half of S&P 500 companies mentioned tariffs. Most of those were to a negative degree. And so what most of them are saying is that they will be passing those on to the consumer, which was a bit surprising because some of these like big box retailers or these are the largest companies in the world, right? But even the likes of Walmart said, look, we're going to try to price protect as much as we can. We are known for value, but even though we get 2/3 of our goods are made domestically, we're still going to, on that other third, we are still going to have to raise prices and those will pass on to
So they were
consumers.
basically saying we're powerless against these tariffs. Like even these big companies can't really push back that much.
Yeah, and the difference being from the first Trump term, the amount of tariffs, there's a higher percentage of tariffs, and the timing wasn't a phase-in. It was like going to happen all at once. And so that was something that companies said they were really going to face challenges with, because you can't move your supply chain, immediately, right? That takes years, that takes lots of money. And even the companies that said, like Steve Madden, for example, the shoemaker said, we are going to try to move to some other places that aren't impacted by tariffs, but that's going to cost us a lot of money and that's going to take some time. And those costs will get passed down to consumers. So no matter what it was, we almost heard across the board that these S&P 500 companies, if tariffs are implemented, those will have to be passed on.
So obviously, we're looking at first quarter results. So these are how companies did in the first 3 months of the year when tariffs were nascent, right? They were just beginning. So we might not see an actual earnings hit from even companies that will be dramatically affected. We won't necessarily see it yet. So what kinds of things should we be looking for from earnings reports? You mentioned companies talking about tariffs. Is it forward guidance? What are other things that we might hear or see in earnings reports that will spark the market and, move prices?
That's a good point. Earnings season's always backwards looking, right? So while we care about the results and stocks will often, go up or down depending on whether companies beat or missed, it's really the forward-looking guidance that we want to be aware of, right? Because currently Q1 expectations are quite good. Their S&P 500 earnings per share is expected to increase 7% year over year.
That's a long streak of increases, right?
That is the seventh consecutive
Wow.
quarter. Revenue's a little lighter at 4%, and that's the 18th consecutive quarter that we've seen these constituents increase sales. And so neither of those numbers are to sneeze at. I'd say the one sort of worrisome trend is how analysts have ratcheted down specifically on bottom line estimates. That 7% I just mentioned back at the beginning of the year was expected to be 12%.
Interesting.
So they've come back in, they've pushed estimates down mostly for the first half of the year because of this uncertainty, and they're pushing most of the corporate earnings growth into the second half of the year. But again, I've covered earnings seasons through the COVID lockdowns, through the subprime mortgage crisis. 7% is a great number. And as we know, where we start in the beginning of the quarter, we don't always end because a majority of companies beat, because companies issue guidance that is very conservative. We know the game. They issue conservative guidance, hoping to underpromise and overdeliver. That's a way to get the stock to pop when you say, well, we beat, we actually ended up beating on both of our metrics. What I will say is also somewhat worrisome is that more companies are issuing negative guidance for Q1 than we see historically. And so
like
again,
dramatically so, or just a little bit?
Yeah, I think that so currently we've got 107 companies from the S&P 500 have issued guidance for Q1. 68 of those are negative, 30-something, whatever the differences are positive. We're running higher than both the 5-year and the 10-year average at this point. So that's a little worrisome when you see breaking from some of the averages. But again, this is a little bit of a game corporations play.
Telis and I have both covered a lot of earnings reports, and we know that sometimes the stock doesn't move in the way you expect it to. So do beats and misses really matter? I mean, what should investors actually be looking for on an earnings report to tell them how the stock's going to move?
Yeah, it's funny. I feel like I have been covering earnings for 15 years. I feel like at one point, the beat on the top and bottom line really mattered. I feel like it's mattering less because there are different KPIs for each company, right? If you're looking at
KPIs are like numerical targets that people are looking at that might not be earnings, revenues.
Right.
The
And
big
it may be
headline
company
numbers.
specific, or like Netflix, it might be new additional subscribers, right? For some of the social media companies, it may be monthly active users, and sometimes you have an idea, okay, for Apple, will it be iPhone sales? But each quarter that target could also move. But yeah, and guidance is a huge piece of that. Back to your earlier question, Telis, like the quarter's backwards looking, all of those metrics are backwards looking. It's guidance going forward that you really want to pay attention to. How does it compare to what analysts were expecting, and how does it compare to prior guidance that the company issued? Investors really don't want to see, especially this very crucial quarter where there's so much uncertainty. They are not going to react well to guidance that is moving lower. Similarly, last year we saw price earnings ratios, valuations were so high that you had to be perfect, especially like the mega tech names, the Mag 7. It was like investors really wanted everything to line up. A 1 penny beat wasn't going to do it. You really had to come and show that the strength was continuing because the price you're paying for these stocks have increased so much.
Yeah, I want to ask you talked about this kind of, expectations are changing. I feel like Delta and maybe Airlines have been an interesting one, right? After the fourth quarter reports, Delta was very optimistic. They came out in January with positive indicators. The stock was doing well. But then, in recent weeks, Delta has lowered its first quarter outlook, citing reduced consumer and corporate confidence and economic uncertainty. So, that seems like a kind of a bellwether that, if people aren't flying, they're probably tightening their belts in other ways too, right?
Yeah, it's interesting you say that because CEO of Delta, Ed Bastian, had said back in January, this is going to be a record year, best year. So, and then 2 months later, as you said, they issued guidance saying, well, actually, they pulled back. Earnings per share on the year fell from originally 70 cents to $1 a share, and now they're down 30 cents to 50 cents a share. So that's a meaningful drop. And like you said, certainly a bellwether. They actually report on Wednesday. So before we even hear from the big banks, Delta comes out. And it's not just them. America lowered guidance last month.
American
Airlines lowered guidance last month. Southwest not only lowered guidance, revenue expectations are now 4%. They were 7%, but they're also going to charge for checked bags. They've never done that before. United didn't lower guidance, but at the JP Morgan Industrials Conference back in March, they echoed the same sentiment. We're seeing travel demand falling for government. So a lot of federal workers losing their jobs. So you're not seeing as much travel on that front, but also leisure travel. And like you said, that was like a hot spot post-COVID.
Absolutely.
Everyone
Definitely.
couldn't wait
Revenge
to get
travel.
back out.
Yeah.
Exactly. And even as recently as January, that trend was expected to continue. So to see it drop so precipitously just in 2 months, to your point, means consumers are really tightening their belts on the things that they were willing to spend on. The travel, the leisure, the experiences. We just saw this in the recent inflation report that dining, going out to eat has fallen. And that was one area that certainly benefited.
That had been a
post
stalwart of
COVID.
consumer spending the last few years.
What
Wow.
about
Absolutely.
another mode of transportation, which we can't really live without, which is cars? I think
Yes.
that's going to be a big focus in this quarter, right?
Gosh, that seems complicated to figure out with the tariffs on.
I know.
A car made here has imports. A car
Yes.
made over there has export.
Right.
You know, it's so
Yeah.
complicated.
We
And
know-
can the automakers pass along these price increases?
They've been struggling even before tariffs. So
Yeah.
the big three here in the U.S. struggling with competition. Obviously, the tariffs, in a way, meant to make that better. But as you point out, the tariffs aren't only on the completed vehicle, which is, for GM, Ford, Chrysler, is completed here in the U.S. It's those parts that are coming from low-cost countries, abroad. And each of those will have a levy placed on them. And so the automakers have warned this will be disastrous for the industry. And on top of that, as you mentioned, not only will that drive up the cost of cars that they're already having trouble selling, but now we've got a consumer that's really holding back on big ticket purchases like automobiles, like, appliances. And so it's like a double whammy for that industry.
And didn't President Trump explicitly warn the auto CEOs do not raise prices as a result of these tariffs? So the spotlight's kind of on them right now.
I suspect there's a bit of negotiations going on in the background with regards to these tariffs and getting exemptions on those parts tariffs or certain, low-cost parts to. But again, we're kind of in this fog of uncertainty around what the tariffs are, what they're on, what the timing is. But I have to imagine those CEOs are going to the administration and trying to negotiate those right now.
Could there be companies that actually benefit from this dynamic, right? Like we have, say, a company like CarMax, right? They report next week. Maybe you're going to rush out and buy a used car, right, before you think the prices of cars are going to go up. If you think the price of auto parts are going to go up, maybe you rush out and you buy all of the parts you need, now, right? You get a couple of windshield
Do people
wipers
do
for your.
that?
Yeah.
Well, maybe you should,
Yeah.
right? Get those
Yeah.
winter
Yeah.
tires now
Yes.
before
Yeah.
the price increases. So,
Yeah.
so could there be companies that actually have great first quarters or give strong guidance
because of the
all this going on?
anticipation of tariffs. I
Yeah,
guess.
in the short term, there could be strength. I mean, anecdotally, I will just say my sister-in-law was saying, we need a new car. I checked how much it would be to fix it. It's like almost as much to fix it as it would be to just get a new one. I have to buy this now because I have read that I have 6 months until car prices. The tariffs, as we know, impact every good differently. So when will those prices filter down to consumers? Well, if we're talking about produce, that's an immediate thing. You can't
Right.
there's no shelf life for bananas. So cars, there's obviously an inventory that's already out there on the lot.
Right.
So yes, I have heard this anecdotally from friends, from family members that are like, I better get my big ticket. I need a new washing machine, so maybe I get that now. So that's just in the short term, right? But in the long term, in the guidance we see, obviously these companies will be reflecting what's going to happen throughout this year and next year, and likely will be a negative impact there.
So in general, if tariffs do what I think, the president and other people around the administration intend, which is to, reshore parts of American manufacturing and things like that, are there companies whose shares or earnings might reflect that now? Or are we just in a long adjustment period and those benefits will be difficult to quantify or things that we might not see for a long time? What should we be thinking about that in earnings now, or is it too soon?
I think it's probably too soon. I think earnings and guidance are going to be a little murky this quarter. I mean, obviously there are intended beneficiaries. I just saw U.S. Steel got upgraded by a few analysts because they are set to benefit at some point, but we know they don't necessarily have the ability to create the supply needed, right, as tariffs are placed on steel imports from other places. So there's going to be an adjustment period even for the beneficiaries. There's going to be a lot of supply, a lot of demand, and they won't necessarily be able to keep up with that supply from day one. So again, I've already started to see it. A couple weeks ago, Dollar Tree, for example, reported they're not one of the intended beneficiaries, but they gave guidance that excluded the impact of tariffs. And I think you start to see a couple flavors of guidance this earnings season. Those saying, here's our guidance, not including the impact of tariffs. Maybe here is another metric that includes it. But I'd say for the most part, some of these companies will go the way of Dollar Tree and just say, they will mention, hey, we know this is going to have to filter into our guidance at some point. But we're not ready to say what that impact is because, frankly, we don't know.
Some of them might be rewriting their guidance up until the minute before their earnings call.
I mean, we've got some, there's certainly news happening every day. And, like you said, the situation might be changing day to day. It might change the day before their earnings, and they might be pulling an all-nighter with the IR team to figure out what exactly they're willing to say about it.
Are there any companies that stand to more or less like directly benefit from tariffs? Are there people who, because of the impact that tariffs have on the price of imports that they compete with, maybe it's because of something that happens because of currency movements and things like that. Are there any companies that are like tariff winners that you would point out?
In the long term, some of the materials names, certainly, moving production back here, it leaves you with less of a choice.
Materials, that's like
steel,
making basic
like
stuff, right?
Yeah.
The raw materials that go into things.
Raw materials,
mining
yes,
things,
yes.
right? Okay.
And then, even on the consumer front, I think about a Walmart, right? They've been doing pretty well. A large portion of their business is grocery. We all need groceries, right? That's why they've outpaced Target in the last year. They have more of an ability to negotiate and to stock those shelves before tariffs go into effect versus smaller businesses that don't have the warehouse space. I will say, though, even those costs, I think, kind of get passed down to consumer to some degree because you do have to pay to stock up and stash, store things. But those bigger box names, there will be more pricing flexibility. And Walmart has said they are trying to price protect for their consumers. Look, they have benefited from inflation. They not only have their target group, but they have higher income groups moving into Target. It's a one-stop shop. You can get your groceries, you can get your discretionary items. As people are trading down and looking for ways to save money, Walmart has been a winner. And again, because of their size and their ability to negotiate with suppliers, hold things in warehouses, I think they can price protect a little better than some of the smaller names in retail.
Interesting, Miriam. Of course, we had an episode a couple of episodes ago. We talked about the difference between small companies and large companies, with large companies having lots of ability to negotiate and other kind of levers that they can pull. It might be the smaller and mid-sized companies that really feel the heat from tariff and trade policy. All right, Christine, we're going to take a quick break, but when we come back, we've got one more question for you. So stay put.
All right, welcome back, Christine. In 30 seconds or less, is there a sector of the economy that will surprise the market this quarter?
Yeah, I think I'm going to go with tech there just because it's gotten such a bad rap this quarter. So many of those Mag 7 names have fallen, but the base case remains the same. A lot of these names' underlying fundamentals are still quite strong. I still like NVIDIA. Their sales for their Blackwell chip have come in about 3.6 million orders.
That's their most advanced chip.
Their most advanced chip that they've recently launched. CEO Jensen Huang said the demand is crazy. And so I'm going to listen to things like that. When the underlying fundamentals are still strong, they're still expected to post earnings and revenue growth over 60%. So I'd say you still see some winners in the tech space.
AI isn't dead yet. Thanks, Christine.
Thank you so much for having me.
Yeah, thanks for being on.
It was my pleasure.
So we're doing a podcast, huh?
Oh, yeah.
It's like we do one every week. God, we do one every week when you say it like that. Okay.